Recessions, disasters, or opportunities. Most would say the former, but the smart investor knows the truth. Now let's take a step back and rethink what we know about recessions. Often we perceive them as periods of economic despair, but they are in fact an integral part of the economic cycle. Think of it this way: economies, like everything in nature, have their rhythms. They ebb and flow, much like the tides. Remember the dot-com bust at the dawn of the millennium, or the housing market crash in 2008? How about the COVID-19 pandemic? Each of these events marked a contraction, a downturn, yes, but they also paved the way for eventual recovery, growth, and prosperity. The smart investor doesn't fear these downturns. Instead, they recognize them for what they truly are: temporary, cyclical, and, most importantly, filled with opportunity. So let's redefine recessions. They're not disasters, they're opportunities. Crashes don't just happen, they develop gradually. Let's take a moment to understand this. Every financial crash has its roots in a period of economic euphoria, characterized by easy credit. This is when borrowing becomes cheaper, and money starts flowing freely in the economy, creating a sense of financial invincibility. People start taking more risks, businesses expand, and investors pour money into the market, often without proper diligence. It's like a party where everyone's having a good time and no one wants to be the first to leave. But as the party goes on, speculation starts to replace reason. Prices of assets, whether they're stocks, real estate, or even tulips in 17th century Holland, start to soar beyond their intrinsic value. The bubble inflates, driven by the belief that prices will continue to rise forever. Meanwhile, the economy becomes increasingly unstable, teetering on the edge of a precipice. And then, just like that, something triggers the fall. It could be a sudden rise in inflation, making goods and services more expensive and causing people to tighten their belts. Or it could be an unexpected hike in interest rates, making borrowing more expensive and pulling the plug on the easy credit that was fueling the party. The bubble bursts, and the market begins its downward spiral. The crash is here, and it's like a domino effect. As prices plummet, panic sets in. Investors rush to sell, making the crash even more severe. Businesses fail, jobs are lost, and the economy shrinks. It's a bleak picture, but it's also a part of the economic cycle, as natural as the change of seasons. However, if you've been paying attention, you would have seen the signs. The excessive speculation, the easy credit, the inflation or rate hikes, they're all indicators that a crash might be on the horizon. And if you spot these signs early, you can prepare. You can make strategic decisions about your investments, ensuring you're not left high and dry when the tide goes out. Being aware of these signs can help you position yourself effectively when a recession hits. So keep your eyes wide open, and remember, the best time to plan for a crash is before it happens. But how can you tell when a recession is on the horizon? That's the million-dollar question, isn't it? The good news is that there are several key warning signs that can signal a looming economic downturn. Let's dive in. First up, rising interest rates. This is often a red flag that the economy could be heading for a recession. When rates rise, borrowing becomes more expensive, and that can slow down economic growth. It's like putting the brakes on a speeding car. It's bound to slow down eventually. Next, we have layoffs. When businesses start to cut back on staff, it's usually a sign that they're trying to reduce costs due to decreased demand. When layoffs become widespread across multiple industries, that's a clear indication that the economy is shrinking. Inflation is another sign you should keep an eye on. In a healthy economy, prices rise at a steady and predictable rate. But when inflation begins to speed up, it can be a sign that the economy is overheating, and just like a car engine, if it gets too hot, it's bound to stall. Then there's market volatility. Now, it's important to remember that markets fluctuate all the time. But when these fluctuations become more severe and unpredictable, it could be a sign that investors are uncertain about the future. And uncertainty is often a precursor to a recession. Finally, we have low consumer confidence. When people are worried about the economy, they tend to hold back on spending. And since consumer spending makes up a large portion of the economy, a drop in confidence can lead to a drop in economic activity. These signs are like pieces of a puzzle. Individually, they might not mean much, but put them together and they can paint a picture of what's to come. The key is to recognize these signs early. This allows you to adjust your financial strategies and position yourself better for what's to come. Recognizing these signs early allows you to be proactive rather than reactive during a recession. Because in the world of investing, those who see the storm coming are the ones who can best navigate through it. In the midst of a recession, it's easy to make mistakes. That's right, when the economy takes a nosedive, even seasoned investors can slip up. Let's talk about some of the most common blunders that can hinder your financial progress. First up, we have panic selling. When markets start to wobble, it's natural to want to protect your investments. But selling off your assets in a flurry of fear often means locking in losses. Remember, economic downturns are temporary, and selling during a recession can mean missing out on the eventual recovery. Next, we have the trap of market timing. This is the idea that you can predict the best moments to buy low and sell high. Sounds great in theory, right? Unfortunately, even the savviest Wall Street whizzes struggle to time the market with consistent success. More often than not, attempts to time the market result in buying high and selling low, the exact opposite of a winning strategy. Finally, we have the lure of chasing hype investments. During a downturn, it can be tempting to invest in the latest hot ticket. Think Bitcoin during the COVID-19 pandemic. While these investments can sometimes pay off, they're often more volatile and risky than traditional assets. Investing in the latest trend without a solid understanding can be a recipe for disaster. Instead of falling into these traps, consider a different approach. Embrace patience and long-term thinking. Recessions, while challenging, are just part of the economic cycle. By keeping a cool head and sticking to a well-thought-out investment strategy, you can weather the storm and set yourself up for future success. Remember, in the world of investing, slow and steady often wins the race. It's about building wealth over time, not overnight. So, resist the urge to panic sell, avoid the temptation of market timing, and don't be swayed by the allure of hype investments. Avoiding these common pitfalls is a major step towards profiting during a recession. So, let's keep our heads, folks. After all, the smart investor isn't just surviving the downturn, they're thriving in it. Preparation is key when it comes to weathering a recession. Just like how a ship is built to withstand storms, your financial strategy should be built to endure economic downturns. Start with building an emergency fund. This is your financial buffer, a safety net ready to catch you in case of unexpected expenses or income loss. Next, aim to pay off any high-interest debt. The less debt you have, the more financially secure you'll be when the economic tides turn. Then, consider automating your investments. Regular, consistent investments can help you take advantage of dollar-cost averaging and reduce the impact of market volatility. Don't forget to diversify your portfolio. Spreading your investments across different asset classes can mitigate risk and provide a level of protection against market fluctuations. And finally, remain consistent. Continue these wise financial habits even in the face of a downturn. By preparing in advance, you can turn a recession into an opportunity. While everyone else is panicking, the smart investor is looking for opportunities. Just imagine a high-end store hosting a massive sale, slashing prices on all their quality items. That's what a recession can look like to a savvy investor. During these economic downturns, top-notch assets often come with a significantly reduced price tag. For those who are prepared, it's like an exclusive shopping spree where everything you've ever wanted is suddenly within your budget. Now, these aren't just any assets we're talking about. We're referring to blue-chip stocks, reliable real estate, and other high-quality investments that have a history of performing well over the long run. These are the assets that, during a booming economy, may seem out of reach for many investors. But in a recession, they're put on sale, presenting a golden opportunity for those with the foresight to scoop them up. Historically, long-term investing during downturns has proven to yield strong returns. Why? Because markets have always bounced back. As we've seen, recessions are temporary and cyclical. The economy will eventually recover, and when it does, those quality assets you've acquired at discounted prices will likely appreciate in value. But let's be clear, this isn't about reckless spending or risky gambles. This is about strategic investing, about having a clear plan and sticking to it, even when things get tough. Enter the concept of the wealth mindset. This isn't about being rich, it's about thinking rich. It's about staying calm amid chaos, keeping your emotions in check, and making rational decisions based on facts, not fear. It's about discipline and consistency, about understanding the long game and playing it well. The wealth mindset is what separates the winners from the losers during a recession. It's what allows some to thrive while others merely survive. It's what turns a crisis into an opportunity. So the next time you hear whispers of a recession, don't panic. Instead, Prepare yourself to seize the opportunities that are sure to present themselves. Adopting a wealth mindset and seizing the opportunities that recessions offer can help you thrive, not just survive.